Hello and welcome to everyone. I'd like to thank everybody for attending today's presentation webinar. My name is George Lewis. I'm the Vice President of Sales here at OptiMed Health Plans. And today's topic of our webinar that we're going to be talking about is our MEC and limited medical programs and why they're needed, what they are. Some of this stuff may be common knowledge among some of the people who are on this webinar presentation today, and some of it might not be. So what we're going to do is go into a lot of what created MEC and why you need it, and as far as part as your portfolio of products, because there's MEC in the ACA world and there's MEC as a product as we market as OptiMed. So we'll get into a little bit about that, and we'll also get into limited medical because it kind of does come into play when you're talking about minimum essential coverage plans and how it can help with those types of plans, depending on the type of MEC plan that you're going to be looking at, and then how to quote us, and then the next steps. So first, though, I'd like to talk to you a little bit about OptiMed, who we are. So United Group Programs is our parent company, if you want to call it. We market and brand ourselves under the name of OptiMed Health Plans. And who United Group Programs OptiMed is a third-party administrator. That's who we are at our heart. And what we've done is we've specialized in marketing niche products in the group health market space. We really don't have any individual products. I'll get into some of the products that we offer in addition to MEC. But what we did is, instead of your typical TPAs you would think is benefit administrative services, which we do, we really specialize in niche products like MEG programs, GAP programs. And what we've done is we've partnered up with insurance carriers to market and administrate those plans under the name of OptiMed Health Plans. So some of the carriers that we represent, you probably are household names like Nationwide. Some of them are, known very well in the insurance industry, maybe not nationwide like Chubb. Some, and even in the insurance industry, may not be as well known, but are just as great in ShelterPoint and Fidelity Security Life. So we take and market their products and programs, and we market it under the name of OptiMed Health Plans. We've been in business since 1968. We only deal with products that are underwritten by stop-loss carriers that are A- or better. We do work with various different stop-loss carriers when it comes to different products. I'll get into that. But we offer also a full suite of ancillary type products as well, life, accident CI type products. We're headquartered out of Atlanta, Georgia. I'm actually located in Pennsylvania, Newtown, Pennsylvania, about 25 miles north of Philadelphia. But that's who United Group Programs is. I mean, we do benefit administrative work for the state of Florida. We administer a breast and cervical cancer screening program for the state of Florida for underprivileged women, and Ohio, the state of Ohio. So when we talk about large employer groups, small employer groups, what's a good fit for your type of company? Anything, really. We have large government entities. We're processing tens of thousands of claims for them every single year. And we have a 5 Life plumbing group down the street from you. It all just is a matter of whatever you have, we have the product and solution potentially for you. So I got a little bit into products, but we're in most states. The states that are blacked out: Alaska, Hawaii, the state of Washington, New York, and kind of the Northeast above New York is a little bit of a dead area for us. But when it comes to distribution, we're in like almost every state. And what we do is, as our products that we talked about, our medical gap plans are probably our number one product that we market and administrate. We have 4 different gap carriers that I mentioned for those different types of products. And essentially, when it comes to gap, I feel like we're the best administrator in the country right now when it comes to gap. We'll be having different gap webinar presentations that'll be coming up in the future. But if you are looking at a rate increase right now on a major medical group that you have, since it's at the end of the 4th quarter coming up, let us know. If you got a major medical increase of 10%, 5% or more, let us know. We could potentially help with that situation with GAP. But today we're going to focus on our MEC and limited medical programs, but I'd be more than happy to talk to you about GAP after the presentation's over. We also do offer major medical level funded, major medical, self-funded major medical arrangements, different various stop-loss carriers, all A rated or A- rated at least or better. Limited med, which you're going to talk about, the ACA compliant MECs. We can do benefit administrative services. We do have full administrative services like being able to do COBRA, FSAs, HRAs. So that's a little bit about us. So let's get into our MEC program. So essentially MEC, why MEC? And really why you would need a MEC program, it depends on what you're talking about. So first and foremost, why you would need a MEC in the group health marketplace is that you're an ALE, meaning you're an applicable large employer that has over 50 FTEs, full-time equivalents, inside of your group. Now, how you come up with that calculation is based off of, and really what you need to do is get with your payroll department or your payroll company if you're a group, or, you as a broker, sit down and maybe help figure it out. Are you first of all, an applicable large employer? Do you have more than 50, not full-time employees, FTEs, full-time equivalents? So essentially George working 30 hours or more per week and Mary working more than 30 hours or less, like 20 hours a week. Well, you have one full-time equivalent employee because it's 150 hours there. So you have to essentially figure out how many FTEs you could potentially have inside of a group before you determine whether it will applicable large employer or not. Then you have to take a look at how many employees are working over 30 hours or more a week. Those are your full-time employees. So under the Affordable Care Act, if you are an ALE, you have to offer minimum essential coverage or you could face potential fines. So that's why you would need a MEC program from the standpoint of employer and their situation as an applicable large employer. Why you would need the OptiMed MEC program is because you are an ALE, but aren't offering health insurance at this point in time. You're a group that has a lot of variable hour employees that don't make a lot of money. Common groups would be restaurants, factory, retail operations, security guard companies, staffing companies, where you have a large variable hour employee base that doesn't make a lot of money. So essentially, how do you get compliant with the law, right? By offering minimum essential coverage to these employees when potentially they won't enroll or they don't make enough money to afford the premiums that their contributions would put into play. So that is the problem, and why you would need our MEC program is that there are going to be certain groups that maybe don't offer benefits, but they want to expand. So I want to hire like 10 more people next year because I think that after the whole COVID situation is going to happen, I'm going to be able to blow this thing up because we've been doing well, and I think we could hire 20, 30 new employees. Well, if you do, you're opening up a whole can of worm. If you have 40, 45 employees today, you're opening up a whole can of worm for yourselves next year, because once you start getting into that applicable large employer, you start accumulating fines. So how do I hire people without worrying about, well, geez, am I over 50? Am I under? I mean, I guess I can only hire 5 more people next year because I have 45 because I don't want to get fined. Then I got to do this whole thing of offering health insurance to all these people. I don't want to get into that situation. So that's the question that we have between why MEC, right? There's the why MEC, why a group needs a MEC, and why a group needs our MEC. So MEC was a thing that was created by the ACA. Prior to the ACA, I would get questions about like limited benefit programs, so they qualify as credible coverage. And what credible coverage was kind of replaced with minimum essential coverage. So essentially, minimum essential coverage is a new term in the insurance world, at least since the ACA kicked in. So it's not that new, let's just put it that way. But it didn't exist prior to the ACA. So what minimum essential coverage means is that if you're an applicable large employer, you have to go ahead and offer minimum essential coverage to your full-time population. And there's 2 fines associated with the requirement. There's the A and the B penalty. The A penalty is that if you don't offer minimum essential coverage, you're going to face the A fine. If you do offer minimum essential coverage, but it's not affordable, meaning that it doesn't meet the 9.5, and I think it's like 9.56 or whatever it is now. If it's not 9.5% of the person's box 1 W-2 wages, their contribution to the plan, and it doesn't have a 60% actuarial value, it's not minimum value, an MVP, a minimum value plan. So if you want to satisfy both laws, or both requirements, I should say, if you want to satisfy the A and the B penalty, you have to offer something that qualifies as minimum essential coverage, that it is affordable, that meets the 9.5% rule, and that has a 60% actuarial value or better and constitutes minimum value, an MVP plan. If you do all that, then the ACA says you're good to go. So that's what we decided to do with our MEC program, is make it affordable to the employer, get them out of the A penalty, and it's just a simple math equation, which we'll get into. So what is our MEG program? Our MEG program is a self-funded, it's a level-funded program, meaning we bill a conventional equivalent premium. So they get a list bill. George's employee-only premium is $50. And of that $50, part of that money is going into a claim reserve, and part of that's going into the administrative fees, commissions, network access. We give them two choices of networks. They can have multi-plan, or they can have First Health as their network. But what we do is it's very affordable. When I say $50, the average premium for a MEC program is about $40 for an employee-only rate, give or take. And what we require is that employer pays 100% of that money, of that $40, $50. And really where you get the variances is how much commission you want to build into the program as a broker. We allow you to put whatever you want to put into the program on a PEPM basis within reason. So if you want $10 per employee per month, that would make the rate $50. Or if you want a $20.60. And we require that the employer pay 100% of that premium. But we accept valid waivers, meaning if you're on Medicare, if you're on Medicaid, we don't want them enrolled in the plan. It's not a Medicare supplement policy, and you do not want a MEC plan constituting primary insurance. But why it's so low cost is that under this self-funded arrangement, and this is where the ACA, you're essentially taking advantage of a loophole in the ACA, which says that if you're a self-funded plan, we all know that, maybe we all know, that you have to cover all these preventative services that HHS requires, right? But in addition to that, there's essential health benefits that every plan must cover, right? If you're fully insured. So you got to cover all the essential health benefits, hospitalization, surgical, physician services, drugs. All of those things must be covered under a fully insured arrangement in order to get approval and become minimum essential coverage in the fully insured marketplace. But when it came to self-insured plans, they gave the freedom to include whatever essential minimum or essential health benefits that they wanted, or include none if they wanted, which meant that all we had to do is cover the preventative services that were required. So that is what our basic MEC plan is. It covers preventative services only, and that's why it's so inexpensive at like $40, $50, $60 a month. And that most groups get somewhere around 90 to 100% back of their claim reserve back. So when we bill them that level premium, and let's say $20 is going into their claim reserve, that times every employee, and we pay claims out of that, because you don't have any high ticket dollar item claims. Your high ticket dollar claims on a MEC program are mammograms for females over the age of 40 and colonoscopies for any employee over the age of 50. But just because they can go get a free colonoscopy doesn't mean employees are lining up around the block to get one. And even if they want one, they still have to be over the age of 50. If not, it's not covered by the plan because the plan's only covering preventative services only. So that's why most groups are getting back the vast majority of their claim fund when we do their run-out period, which we set it up on a 12-month contract, but then we run out claims for 3 months. So it's a 12-15 contract. Well, they'll get their refund 15 months, after the effective date of whatever the unused claim reserve is. And they're getting back about 90% of what they put in that 12-month period. And the reason, why is that if you cover a lab test, it's going to cost 10, 20, 30, 40 bucks. It's not going to break the bank. And the reason why we make the employer pay 100% of the employee-only premium is because of the fact that when you get this money back, we don't want there to be profit from the employee welfare. you're going to be offering this to employees, let's say on a voluntary basis. Number one, there's no more individual mandate, so it does not help them. Two, it only covers preventative services, so they're not going to be able to really use it. So you're really giving them just an awful plan. Three, this is a plan that is designed to really help satisfy the employer's requirement to offer minimum essential coverage, not to give the employee good benefits. So why would we require that or allow the employer to do this on a voluntary basis? We don't want them charging the employee $50 and then getting a refund check back of 40, 50, 70, 100 grand, $500,000, depending on the size of the group, and making money off of their employees. So we require that by paying 100% of the employee-only premium, they're only getting their own money back that they're putting into the equation. This is essentially a low-cost option. That's our base MEC program, right? Now, here's an example of what I was talking about when I talk about the fact that this is just a pure financial almost play. Because let's just say you have a company that has 100 full-time employees, right? Well, the way the calculation of their penalty is done is that you have 100 full-time employees. You get to subtract your first 30. So if the company did nothing and just paid the A penalty, they'd be paying $189,000, right? But that would be after tax. So essentially, you don't get the tax deduct the penalty. So that 189, depending on your corporate tax rate you're going to be paying in future years, is going to be way more than 189. It's probably closer to 240, 250. So you'd be throwing $250,000 out the door, burning it in essentially a tax. So let's say you say, well, that's nonsense. Why would I do that? I'll offer a fully insured program through Blue Cross and Blue Shield or an N or whoever. Get me a fully insured plan, make it an HSA plan, give me the cheapest plan. So let's say you can get a 350 plan, which might not be the cheapest plan, say it's in the middle, whatever. But in order to enroll these employees onto the plan, again, we're talking about not Google employees, we're talking about restaurants, factory, retail operations, security guard companies, temporary staffing agencies, companies that their employees do not make a lot of money. So if you think you're going to split that premium in half and get your participation requirement of 75% through these companies that most have, you're crazy. It's not going to happen. Could it happen? Sure, the potential is there to happen, but I'd bet against it every time. Because I don't feel like, especially if you're going and getting a bronze level program, that you have to pay the first $5,000 of medical expenses before the plan kicks in. Oh, and by the way, I got to pay $175 a month for it on top of it. You know, and I make $20,000 a year or $30,000 a year. I just don't see that happening. You'd be basically working for your benefits. That would be about it. So you'd have to make it affordable, which means you'd have to probably pay $300 of that to make it $50 a month to get the enrollment, the participation that you would need in order to get the 70% participation mark. So now you're talking about 300 times 12, 3,600 a year times 70, that's 252,000. So when the ACA originally came out, there was a term called pay or play. And you don't really hear that a whole lot anymore, pay or play, because there's other options like OptiMed out there now. But pay or play meant, is it more expensive to pay the fine or is it more expensive to cover everybody under the health plan? And what most groups found when the ACA was first rolled out, that it was going to be more expensive to cover these employees under a fully insured arrangement than it would be just to pay the fine. So then it was a financial play of like, well, how much more is it to get them insurance? So I guess I could buy something instead of just throwing the money out the door. So with the MEG program, our MEG program being $50, we're coming in at $42,000, as you could say on this slide. And that's part of that's going to be refundable. So they probably have the ability to get something like 15 grand back off of that 42,000. So it's really maybe 30,000 potentially that they're going to pay. So we've just saved this group minimally. We're going to save them $150,000 annually. And that's the important part of this equation that I want you to understand too, is that this only satisfies the A penalty. The B penalty is if you do offer a MEC program, but it's not affordable, nor does it have a 60% actuarial value or better, then the employee can go get a subsidy and enroll. So you say, well, then, oh, the group will pay 40 and no, you're paying one fine. So if George says, listen, I don't want this MEC plan. I got a subsidized plan on Blue Cross Blue Shield because I have health conditions. I can't take a preventative only program. I have to have a full-blown health plan on the exchange. Then you're not preventing that person, that employee, from getting a subsidy. So I'm adding $4,000 into the equation. So how many people in that group are going to say, oh, I'm getting subsidized coverage? Because again, getting subsidized coverage means that you're making too much to qualify for Medicaid. I make too much to qualify for Medicaid, and I don't have enough spousal income because it's household income. So if my spouse is a doctor and she makes $150,000 a year, only I'm making $20,000, it doesn't matter. That $170,000 is going to disqualify us from getting a subsidy. So it's like, the Goldilocks. You can't make too little and you can't make too much. It's just got to be just right. So how many people in this 100 are going to be eligible for a subsidy, then actually enroll? Because it's not that they're eligible for it. They actually have to enroll, pay their premium, and the employer will pay a fine for that one individual. Now, the vast majority of the groups will have a couple people in that situation. So you'd be adding like $8,000 to the equation. You're still saving them $140,000 instead of $150,000. And depending on the claim reserve in my scenario, it still might be $150,000. Now, you might run into a group that has a bunch of waivers or a bunch of people that are on the health exchange, receiving subsidies. Then you got to make that, again, it's all about numbers. You just have to take a look at how many people they're going to get SOL fines for, how much the OptiMed premium is going to be, because we're not asking them to enroll in our plan because that would be a valid waiver. They're enrolled in an exchange program receiving a subsidy. So we're not going to force them into enrolling. So then how many people are going to be enrolled? And here's going to be the OptiMed premium. And here's how many subsidies we're going to have in our group. And here's what the fine's going to be for that. Is that less than penalty A? And if it's significantly less still, then you would do it. If not, then maybe penalty A would be the best way to go, or B, taking a look at a fully insured program and see what you can do and make it affordable and see how you can work it out that way. But that's the thing. It's all about saving the employer money when it comes to a MEC program. Again, we're not trying to tout these as the best benefits in the world. Now, we do have buy-up plans, meaning we can add extra benefits to the MEC program to get it better, right? So, for example, we can put in primary care visits, office visits, specialty visits, urgent care visits, mental behavioral health visits, x-ray, lab, imaging, and then finally emergency room visits. As you can see, this is like a schedule of benefits for that, where there's really no deductibles on most of the plans except for the one with the emergency room. But essentially, yeah, there's co-pays for primary care visits and specialist visits. So for a healthy individual who may only need to go to the emergency room once in every blue moon because you broke a leg or needed a stitch or something like that, these plans will be phenomenal. For somebody with a health condition, it's not. When it comes to prescription drugs, it's still only going to cover the preventative services that are required under the ACA prescription drugs, which would be contraceptives for the most part. But essentially, we have discount programs we can offer too to get the employees discount drugs. But realistically, this plan is pretty good. Now, obviously, these plans are not going to be the same price as a $50 plan. They go up the ladder. We can quote them out, and it really depends on demographics of what it'll come back with. Most of the time, you're going to see the rates are the same, but depending on certain demographic shifts, you could see different rates or states, stuff like that. But these are our enhanced MEC options that we now offer, that we can go ahead and offer these benefits in addition to preventative services. Now, they do have limits, like there's 8 visits a year, on some of these, 10 on others. There's no limits on some. 2 per year for x-ray and lab sometimes, emergency room. So we can make the MEC better. So really, what does it boil down to? How much does that employer want to contribute to the plan, right? How much do they want to help out their employees? Because if you have an employer that says, well, yeah, I can't afford the major med, but I don't want to just offer a preventative only program. Is there something in the middle that I could offer that's a little bit more affordable for me? That's when these plans can come into play. And the employer doesn't have to contribute more on these higher programs. You can have employee contribution on them. So what it would be a base buy-up offering, meaning you have a MEC basic plan, which is your preventative only plan that you're paying for, and then you would offer a buy-up plan to one of these and have them buy up to it. But we need 10 enrolled minimum in the MEC basic and pro. The other 3 require 25 minimum enrolled. So that's why I say employer contribution, because if, well, let's say the MEC Advantage is 150 compared to 50 and the employee has to spend $100, are you going to get 25 more people enrolled in it? I don't know, but you got to get 25 people enrolled in it. So if the employer is contributing $75 more towards that plan because they want to kick in more money, well then, yeah, for $25 more, can I get the MEC Advantage program? You'd be silly not to. The first time you go to a doctor's office, you would be paying for yourself almost. So employer contribution really drives these programs. So as an overview, what we're trying to do is satisfy A penalty, not B. There's self-insured programs. We do refund 100% of the unused claim fund. We do have hybrid, meaning buy-up options available on the MEC. And they're essentially guaranteed issue. We're not asking health questions on these because there's no hospitalization, surgical, maternity coverage. None of these things are included with our MEC programs. They're not full-blown comprehensive major medical. Now, limited medical, why that's important is, let's say, for example, you do want to go with a voluntary offering, something that would be a buy-up to the MEC, but you don't want to include it in the self-funded arrangement because the employer is really not going to pay up for it, right? Well, with a limited benefit plan, it's a fixed indemnity plan that essentially does have covered services for things like doctor office visits, but it pays benefits on a fixed indemnity basis. So for example, and we'll look at a schedule of benefits in a second, you might get $50 towards an office visit. We use the same network. So your same network that you have for the MEC, you would have for your limited medical program, but you could also offer limited medical on a standalone basis. It's not, you don't have to have a MEC. You could walk into a 10 or 15 life group today that has no chance of ever being a large applicable employer, but basically they can't afford major medical premiums. Well, I would go in there and say, okay, can you afford way less? Could you afford $50 a month? Could you afford $70 a month to contribute towards your employees' benefits? $100? Well, then I can get them a limited benefit plan. And depending on how much they go up to, like 100, I might be able to get them a dental plan, a limited medical plan, maybe a vision plan, and have the employer pick up the cost of it. So instead of trying to get them to buy into a comprehensive major medical plan and spending, let's say on a 10 life group, $30,000 a year, I could walk in there and have them spend maybe 10, maybe under 10. And that might close the deal because, yeah, I'd like to offer something. I just can't afford $30,000 on a 10 life group. But yeah, I can afford $9,000. It's a significant difference. That's where we see limited medical plans coming into play more. We used to see it a ton. I mean, before the ACA kicked in, we had a ton of limited medical business with variable hour employee groups because they didn't need minimum essential coverage at that point in time. They just wanted to offer voluntary benefits to their part-time and variable hour populations. So, we had clients like Applebee's and H&M department stores and Captain D's restaurant down in the South. We had very large clients that would offer these plans to their part-time and hourly populations because they didn't qualify for the major medical plan, but they wanted to offer some type of benefit to them. So they still exist under the ACA as accepted benefits. We can still sell them because they pay on a fixed indemnity basis, even though they're fully insured. They're considered dental and vision under the eyes of the ACA. But essentially, they can be offered 100% employee or 100% voluntary or 100% employer paid, anything in between. And essentially, they're guaranteed issue. There's no pre-X. And all we need is 5 enrolled or 10%, whichever is greater as far as participation. But the other thing is that you can offer this to the people that are also valid waivers that aren't Medicare or Medicaid, because they could use this kind of like what we market as a gap program. They can use it to help supplement their other out-of-pocket expenses. So for example, if they have a $50 copay on their major medical plan for a doctor office visit and they can get a limited benefit plan that has a $50 indemnity benefit, well, there you go. It'll cover your copay. So you can actually have employees who would want to roll on a voluntary basis that have high deductibles or big copays on their major medical programs. They might want to enroll in this type of program in order to help with their offset their out-of-pocket expenses on their major med, much like companies like an Aflac would market. But instead of using this as your primary insurance, as you would if you have a MEC and limited medical program, you'd be using it as a secondary insurance, just like with Aflac, you'd be filing the claims to us as an employee if you had major med. So you could offer it to more than just the variable hour population. You could offer it to everybody. And like I said, it does cover benefits for doctor office visits, ER visits, outpatient, ambulance, surgery. It all depends. Not every plan has a benefit associated with it. So for example, like these plans all have like inpatient hospitalization, surgical, but then you might go down to another plan where there's no surgery benefit. This surgery benefit on the executive 80 plan that you see right here, the column 1, 2 down, inpatient surgery, is $1,500 for 2 days. Meaning you get $1,500 one day and $1,500 the other day if you had 2 different surgeries, inpatient, and they would have to incur on 2 separate days. But we would have plans that would have no benefits for that. All it would be the network discounts. So all the benefits remain the same. It's just whether or not we pay any benefits towards it. But these are customizable, meaning like, you know, is there anything you do with that surgery benefit? Maybe you have a higher surgical benefit. We might be able to add that in. We might have a higher hospitalization benefit if you want. Or you go, you know what, I'm not really too concerned about the hospitalization stuff, but I really want to beef up the office visit coverage. We can customize these plans. But what they're designed to do is give you a low-cost option on a fully insured basis that is guaranteed issue. It can be voluntary and it's customizable, and it can be sold into the small group market as supplemental or primary plan of an offering of an employer, or to supplement our MEC program. So your broker advantage, why sell it? Because it allows you to come in with a creative alternative. As I said, most brokers still today are going to come in with a pay or play option for these groups. Well, here's your major medical plan, and give me $30,000, give me $200,000 to get rid of that $180,000 penalty, or pay $180,000. What would you rather do? You get to walk in there and say, hey, about 40 grand, and I get rid of the problem, minus any soft fines you might get, and we'll figure that out once we get the waivers. People who are waiving off will find out if they have individual coverage or they're through their spouse or however they're covered. We'll figure out how many people are getting subsidized coverage through the waivers. So we'll be able to tell you almost exactly how much money you're going to save compared to paying for that fully insured major medical program. Now, you want to pitch that first, fine, but have a backup, and the backup would be having our MEC program. And what it's going to be able to do is, again, keep you ahead of your competition, drive additional revenue streams. Again, some of you may market to the 10, 5, 15 life group, 20 life groups out there, the under 50 market, and some people on this call do not. For those who do, don't walk out of that office or walk, I guess nowadays with COVID, get off that call or that go-to meeting without at least pitching a limited medical plan and saying, listen, if you can't budget this $30,000, could you at least budget $50 or $70 or $100? Would you be willing to do that? Because if they're willing to do that, you have a sale. Heck, if you ask that as a qualifying question before you talk to them, how much money are you willing to spend per employee per month in order to offer benefits? If they say, oh, $50, great. We got a solution for you here at OptiMed. At least you'll be able to get something in with that group. And who knows, financially speaking, 2 years or 3 years from now, they might be in a position where they want to offer major med, or they have to. And guess who's going to be their broker of record? You will. Because you would have our limited benefit program in there from the very beginning. And I'd rather walk into a group and make something rather than nothing. And when you're dealing with OptiMed, you're dealing with an outstanding TPA with amazing customer service. And I'm here to ensure that you and your groups have the best overall experience that you can possibly have. So whether it's a 5-life group or whether you stay in Florida with us or whoever you are, we're here to make sure that you are happy with us. And I won't lie to anybody on this call and say that we've never made a mistake on it. It's how you fix your mistakes. Mistakes are going to happen during the course of doing business for 50 years. It's how you fix it. Do you take days, weeks, months to fix it? Or is it fixed in hours with an email saying, sorry, we fixed it. Our apologies. It's all done. Here you go. Here's the resolution. That's how we handle customer service. We don't have a million prompts for people to go through when they call into our 1-800 number. Essentially, when they call in, they get a live person. Yeah, they'll hit a couple prompts. Are you calling for billing? Or are you calling for customer service? Do you have a GAP program? Do you have a MEC program? But once they've hit a couple prompts, they're in the customer service. And our average wait times are under a minute. So when we talk about outstanding customer service, and if you check out our website, optimedhealth.com, you can file claims online with us. There's videos. There's instructions on how to file claims with us, whether it's a GAP program or a MEC program or a limited medical program. There's video instructions. There's online tutorials about how to file their claims, what forms they need, how to fill out the forms. And there's a portal for both the employer, the employee, you as a broker. You have access to portals to do adds and terms, make changes. The technology is there that brokers need nowadays. But if you want to go you're old fashioned and you want to just, hey, I want to email my adds and terms, no problem. We can take care of that too. So additional benefits to the MEC and to the limited benefit program, we include these non-insured benefits on everything that we do as far as level funded major med, MEC, limited medical, GAP programs. We include all these non-insured benefits. Obviously, our patient advocacy and customer service, but telephonic doctor office visits, especially during the time of COVID right now, free to the employee, no copay. They can use it as many times as they would like. So they have unlimited telephonic doctor office visits with no copay through our program. And that's a huge advantage, especially when you're dealing with MEC and limited med or even our GAP programs, especially when you're hitting the middle of a pandemic and you want to use telemedicine and you have to pay $20, $30 to your major medical plan, or you don't even have it at all. You have an employee assistance program, EAP. They get a free legal consultation. They get a free mental health, whether it's counseling on anxiety or family issues. They get 3 counseling sessions. We'll do the COBRA administration on our programs. So if you have the MEC and the limited med or whatever you sell to the group, you don't have to hire a COBRA administrator on top of it. We'll handle all the COBRA for them. All they have to do is term the employee. We'll send the notification. And we also have a workplace wellness program. It's nice to get into group healthy. A lot of people, especially in large corporations, they're always pushing, wellness programs. This is the wellness program that you could use in a small group or, a part-time group that would essentially maybe help get some of the people healthier in the group. So quoting, it's pretty simple. As far as information for the MEC program, really all we need is a census with the date of birth and the gender of the employee. We don't need dependent information. And then the basic group info, their name, their address, their SIC code, and what effective date you're looking for. And then when it comes to MEC, yeah, I'd like to see some of these enhanced options, or I just want the basic MEC, and how much commission you would like to build in as a broker on a per employee per month basis. Those are our direct email and contact lines. The other option that you do is there's what we call our OptiRater. This is kind of like the overview of what the OptiRater looks like when you come into it. And what you can do is just go on and quote it out yourself. It'll allow you to pick whatever programs you want to quote. So if you want to quote GAP or you want to quote our dental or our limited med, minimum essential coverage is there, vision, whatever it is you're looking for, major med. And again, whenever, group address, census. What we do is you use that registration link, and then once we verify you, you can go in and start using operators, and you can quote, and you can do it right online. Next steps, like I said, just call us. If you have questions about today's presentation, if you'd like us to be conferencing, I know I'm doing one for a broker on this Thursday, where I'm going to be talking with the group about the MEC program, because they feel like, we're the experts in it, and they like us to be on the call with them so that we can answer any questions that the group has that maybe you're not, 100% on, because this is a new product. don't worry about it. We're here to back you up with all those questions and answers that you may not have. And I look forward to hopefully working with some of you in the future. Thanks again, and have a great day.